Chairman Powell said, in all likelihood, the Fed would raise interest rates. He would get aggressive if inflation seemed to be embedding into the system. We had taken a point of view that at the time, COVID was a shock to the system, much like the stock market crash in '87. It was a one-day 25% crash. And then 9/11, the terrorist attack. And our point then was, after a shock, the trends that were in motion tend to come back into motion. So in the 80s, the strong stock market and the strong economy continued after the shock, after we got over the shock. And in 9/11, 2001, we were in recession before. There was the tech and telecom bust, and the shock made everything a little bit worse, a little rebound, and then back into that recession. And as you know, that was a right call for COVID. We went into a V-shaped recovery thanks to tremendous stimulus, and thanks to the fact that it was a shock that was not going to be completely debilitating given the united stimulus around the world. For the past year, I feel like we've been going through a little bit of a different kind of shock, and it's associated with inflation and interest rate fears. Now, during shocks, and we saw this during COVID, what we tend to see in the public equity markets is what I call algorithms or quantitative trading strategies that just pick up on a few variables and press hard in terms of betting against them, the stocks associated with them. So during COVID, we could see very clearly that cash cushions and cash burn were the two primary variables that these algorithms seem to be seizing on. And they hurt our stocks disproportionately. In the span of 3 to 4 weeks, our stocks, many of them were down 75%. Because many of our companies are earlier stage, we're the closest you'll find to a venture capital fund in the public equity markets. And of course, at that time, we said, innovation solves problems, and we have a lot of problems now. And of course, our strategies took off once the coast was clear for the markets. Well, in the last year, this fear of inflation and interest rates moving up and destroying the valuations in the marketplace have gripped the markets, and it seems as though the algorithms were focused primarily on high valuation stocks. Now, in our strategies, we own what look like very high valuation stocks in the short term. If you're only looking at this year. And I do realize that investment time horizons shrink during times of turmoil. But if you take a look at the multiples on our stocks, given a 5-year investment time horizon, you will find that they are at or below very mature innovation stocks. In other words, we've made that assumption. The valuations are going to compress dramatically. And to the 18, 19 times range when it comes to enterprise value to EBITDA. So we've already made the assumption that the valuations are going to come down. We believe what's happening in Russia and the Ukraine right now is turbocharging the shock to high valuation stocks that began last February when we were all getting vaccinated, and hopes were that the economy would continue to gain momentum. And so we now believe that Russia and Ukraine have turbocharged that shock and actually, hopefully, moved it into a period that is very cathartic and helps people understand that what's going on right now, from our point of view at least, is that the higher interest rates and higher inflation are acting like taxes on the system. And we've been talking for a while about this, about consumption slowing down dramatically. If you look at retail sales, and I'm talking about real retail sales, take out the inflation, and real consumption. We've seen a dramatic slowdown since October, and we are beginning to see inventories pile up. All of that is working out the way we expected it to. Our surprise is that many economists and strategists out there aren't putting two and two together. They're paying attention to other variables, which there is conflicting evidence, but they're paying attention to other variables that support their point of view. I'm going to go through now the policy, economic indicators, and so forth, and we'll build the case here that just like during COVID, innovation is going to solve the problems associated with supply disruptions. Here we go again, supply chain problems. This time out of Russia and Ukraine, with energy and food, some of the areas most disrupted. So these are necessities, so this is getting very serious. And we believe these are serious taxes on the consumer, especially lower income consumers, and explain why consumer sentiment has fallen apart broadly. So let's go through that right now, and we will wind up saying that because of what's going on right now, innovation is going to get another booster shot. COVID certainly accelerated many trends, and we think the higher costs associated with supply chain issues, and now even more so with Ukraine and Russia, that companies and consumers are going to turn to innovation, and that whatever our growth expectations for our companies were within the last year, they have just accelerated again given this new crisis. So now let's turn to monetary policy. This week, Chairman Powell said, in all likelihood, the Fed would raise interest rates. He also did say, when asked the question in his testimony, that he would get aggressive if inflation seemed to be embedding into the system in a 70s-like scenario. Well, we thought about the analogy to the 70s, and we know a lot of especially old-time investors who were around during the 70s are forecasting just that, inflation embedded in the system at a much higher than expected rate. We are not expecting that.